Right. Hello, everybody. Thank you for joining us. Jane, who's joining us, I think you put a question saying there was a problem with the sound. I think that was from our side. We forgot to switch on the microphone. So yeah, we should be good to go now. So we were just waiting for a few people to join us. So some of us have come on board now, and I'm sure a few people will kind of join throughout, but we'll get started with the webinar. So today here we are, and thank you all for joining us and running a series of webinars. And today we're talking about the NHR scheme in Portugal. My name's Matt Penfold, advisor and director here with Paul Correa, our managing director. What I will do is just run through quickly the agenda that we're going to cover for you today. So we'll do a brief introduction of the company for those who haven't met or spoken to us before. Then we will move on to the content. We will do a kind of brief intro and an outline of the Non Habitual Residency Scheme in Portugal. Then we will cover the exit side, so exit in the UK and the planning that you need to take into account with regard to that. We will then move on, briefly talk about visas, but then move on to the core element of the webinar, which is the tax benefits of NHR and the tax planning opportunities that can be combined with that. Finally, we will cover CGT on UK businesses. We have a few frequently asked questions, and we will give a little bit of additional advice on those relocating and our roadmap that we recommend people to follow. At the end of the webinar, we invite all your questions. You can submit these as you go on using the chat function on Zoom. Feel free to write your questions and Paul and I will answer those at the end. So we'll start off with who we are, Fiduciary Wealth Management, as you can see. And Paul, as our Managing Director, founding partner, can you tell us a little bit about the company, please?
Yeah, well, I personally started my career in financial services in 1984, working for the Inland Revenue. I then moved to, well, I started, I think I ought to correct that. I started my career as a civil servant in the Inland Revenue in 1984. I worked there for almost 6 years and then transitioned into financial services in 1989. Therefore, I've been working in the financial services, private banking, wealth management sector now for 33 years. That gives my age away, unfortunately. I'm a chartered banker by profession. I co-founded Fiduciary Wealth in 2007, together with my partners, the owners of the longest standing law firm in Gibraltar. I sold us 1892 with a 130-year history. We also happen to be a member of MGI Worldwide, which is a top 20 ranked global accountancy network. In fact, it's one of the oldest such networks, established in 1947. Today, it's represented by 10,000 professionals across 460 locations, 100 countries, and driving more than $1 billion in revenue. As a firm, we are completely dedicated to positively shaping the wealth of the British expatriate community through tax-led wealth management advice. Personally, I'm a great believer in the need to change or to engage in a broader dialogue to develop deeper relationships and provide more client-focused solutions.
Okay.
I'm also a strong advocate of the need to offer expats holistic, tailored and impartial advice, and advice which stands the test of time.
Okay, thank you for that, Paul. And so just one follow-up question. So when it comes to servicing expats or clients abroad, what's the difference between the fiduciary wealth approach?
Well, that's a really good question, Matt. Thank you for asking. I often get invited to a panel of speakers to discuss financial and lifestyle considerations of moving abroad. And it does strike me as a bit odd that when I'm sitting alongside my peers, very often I hear them talk solely and exclusively about the company and their internal focus, meaning how many jurisdictions they're in, how many people they employ, how fast the company is growing. But I rarely ever hear them talk about externally about the clients, which is the lifeblood of any business, and certainly it means a lot to us. So that has made me reflect a lot on our values and purpose and why we established the business. I think, there's a few core values which are close to our heart. One of them is that we have a family office approach to serving our clients, offering a highly personalized service in which each and every client relationship is really important to us, and they're highly valued. So relationships are at the heart of everything we do. And we have a long-term focus, whether that's how we manage the assets or how we structure for tax, financial and retirement planning. Is not just the short term and the putting a band-aid to try and solve the problem. It's all about thinking of how we preserve the client's legacy for their future, and of course for the futures of the children who depend on them. So we are extremely passionate about positively shaping the wealth of the expatriate community through tax-led wealth management advice. That's what keeps us going every single day. And ethics and integrity is key. So we always do the right thing at the right time for the right reasons. We offer a truly transparent pricing model, a very competitive one, and our advisors are salaried rather than commission-only agents or consultants. And I think that's probably a key differentiator as far as we are concerned. So our mission, Matt, is very simple. We want to help experts and their families. That is what we do. And if you ask me how I could sum it up in just a few words, I would say it's all about service. It's all about helping. It's about caring about the clients and, of course, supporting them through their journey as an expat. I know it sounds terribly simplistic and doesn't sound very, very interesting, but that's who we are and what we stand for.
Of course, yeah, wonderful. Thank you for that, Bob. Okay, so we're here to talk about the non-habitual residency scheme in Portugal, which is a bit of a mouthful, so I will call it the NHR as it's commonly known from now on. I think one of the key things which we have a few lines on the webinar now is people often get the NHR scheme mixed up with, and this is mainly post-Brexit, mixed up with your visas. It's the NHR isn't a right to residency, it's a tax scheme. You need the right to reside in Portugal, and then the non-habitual scheme surrounds that. So NHR was, and the reason people are misunderstood is the name, non-habitual. It sounds like you don't have to actually live there. You do have to live in Portugal, minimum of 183 days a year, so that you become a Portuguese tax resident. The non-habitual actually refers to that you can't have been a taxpayer in the previous 5 years. Otherwise, you're unlikely to qualify for the scheme.
It's surprising how many people get that wrong.
Yeah.
And I think, Matt, for the benefit of the audience, I think we were in Portugal last week, all the way up to nearly Porto, and we keep hearing the same thing. Can I become tax resident of Portugal but not live there? If I get my visa, I get all the tax benefits. And so there's so much misunderstanding around visas and non-habitual residency. And what strikes me as odd is that how many professionals on the ground promote non-habitual residency on the basis you don't have to spend any time in Portugal, which is absolutely shocking, because there will be tax residents somewhere else and therefore liable to tax somewhere else, and it's shoddy advice.
No, it's appalling, and it's interesting to say that about our visit last week, Paul, because the other thing I took from it as well is there's so many people we come across and they say, oh, I missed my chance for NHR, and the timing is very important with obtaining your NHR. So the year you become tax resident. So, for example, somebody has been living in Portugal since March of this year, 2022. Then you have until the 31st of March, 2023 to obtain your NHR. If you leave it beyond that, then you miss that opportunity and it's effectively gone for good, because you become a Portuguese taxpayer without obtaining the NHR. So it's very important that you understand that it's a tax scheme, therefore you have to live in Portugal, and like you say, Paul, even if it did work that way, you would still be living somewhere else, so you'd have tax obligations elsewhere. But also to make sure that you time it right, so you can achieve the NHR.
But we had a couple of cases, right, where they come to Portugal.
Yeah.
They weren't given advice on how to restructure their tax affairs because they're moving within the EU. So no advice given.
Yeah.
And then they settle, nor have they been pointed in the right direction and telling them, now you need to get the NHR as non-habitual residency certificate. So they end up going to Portugal, having their tax and financial affairs structured based on another country.
Yeah.
Inadvertently triggering a tax residency in Portugal, but with no NHR certificate, and then wanting to somehow reverse that, which becomes incredibly difficult to do.
Yeah.
And it just shows that you have to follow meticulously a number of steps in the right order, not to get it wrong, which is why, trying to Google and trying to understand the complexities is never a good starting point.
No, absolutely. I mean, yeah, important to plan in advance, and Google can be our friend at times, but I mean, we've come across things via Google searches and competitors or other so-called advisors there, and for me, Paul, it's shocking some of the stuff people say. You can have NHR, but you don't need to. You only need to spend a week in Portugal. Complete rubbish. So it's important to know exactly what you're doing, because not following those right steps in the right order can be very costly. So yeah, NHR has been in place 12 years now. Multiple tax advantages, which I'm sure you will know as some of, but we're going to cover those later. And the NHR is offered for a 10-year period. Now, you can take a break from the NHR during that period, but you will lose that time you spend out of Portugal. So a very simple example, you reside in Portugal for 2 years, you use 2 years of the NHR, you move elsewhere for another 2 years, you can return to Portugal, but you only have the 6 years left rather than the 8 years. So we move on to the next approach. So of course we're talking about the NHR, and it's not as simple as that. You do have to make sure that you are exiting your country of residence and the UK with a lot of people we speak to. So Paul, can you, regarding exiting the UK, what do people watching or listening today, what do they have to do to make sure that they don't fall foul?
Well, there are many different factors which will determine whether you're a UK tax resident or not. And the number of days you physically spend in the UK during the tax year clearly is an important factor, but it's not the only consideration. So I don't think you can just focus on that alone. You also need to consider the pattern of your presence in the UK and the connections to the UK. And it could include things like your family, your property, your working life, and any social connections that you might have. The UK Statutory Residency Test 2013 allows you to plan the date in which you become non-resident in the UK and actually determines the number of days you can spend in the UK without accidentally re-triggering UK tax residency, which would undo all the benefits of establishing non-habitual residency. I mean, that's really an own goal, right? You go to great expense and effort to relocate to Portugal, and then you don't pay attention to the detail. The devil is always in the detail.
Absolutely.
And you find out that you've now re-triggered UK tax residency, and you've got 2 jurisdictions claiming residency. So our advice is always to exit at the end of the UK tax year, which is on the 5th of April. That is a much cleaner break for tax purposes, and where possible, it makes absolutely sense that you do so. However, you may decide under certain circumstances, you may decide to split the tax year between the UK and Portugal, and there are 3 specific situations where split year tax rules will apply automatically without requiring guidance from HMRC or a ruling from HMRC, right?
Yeah.
Because you go for the clean tax year. If that fails, you go for the split tax year.
Right.
But ideally, you'd want to do it under those 3 specific situations where it's granted automatically. You don't want to go onto a lottery, right, and go to HMRC and then see how they interpret it. That would be, again, would make absolutely no sense. So the 3 specific situations are if you begin full-time work overseas, okay, if your partner or spouse starts working overseas and has full-time employment, and thirdly, which is an important one, which we often oversee, you have to leave the UK permanently to reside abroad, not temporarily, but permanently. That means that you no longer have access to a UK property prior to the end of the tax year. So I'll give you an example. You know, John Smith, he leaves the UK on the 28th of September 2022. Yeah. And he goes for a split tax year with Portugal, and he's off to Portugal. If he has a UK property, if it doesn't qualify under the full-time employment, the other 2 rules I've given you, he should really sell the property before 5th of April 2023. Yeah? Yeah. So that's how it works. So that's, again, a lot of detail, but you can get it completely wrong. So yeah, UK statutory residency test, everyone ignores, few pay attention, but it can be very costly.
No, absolutely. And it's another one of those steps to avoid, because NHR is great, but then if you're still paying tax in the UK, there you go.
Precisely.
Okay, wonderful. And then UK domicile. Now that's something that I speak to people about, and again, it's quite misunderstood. So can you tell us a little bit about the UK domicile and how this may affect someone's UK inheritance tax?
Yeah. Well, firstly, the good news is once you move to Portugal, there's no succession tax in Portugal for direct descendants. Now, the bad news is that you're likely to remain exposed to UK inheritance tax, because inheritance tax in the UK is based around the concept of domicile of origin rather than tax residency. So Napoleonic law countries like Spain, Portugal, Italy, France are based, inheritance tax or succession tax is based on tax residency. Anglo-Saxon countries, UK and Ireland being an example, are based around the concept of domicile. Now, domicile of origin is something you acquire at birth and is normally taken from your father. And whilst it's legitimate for an individual to claim a domicile of choice by settling in a new country with intention of staying there permanently, I have to say that this is always fraught with difficulty, as there are no fixed rules regarding the switch from a domicile of origin to a domicile of choice. And the burden of proof, as far as HMRC are concerned, will always fall on the individual to prove that they have actually acquired a domicile or a new domicile of choice. And in my experience, and Matt, you probably come across quite a few cases too, it's not uncommon for Brits to return to the UK temporarily. I mean, it could be due to ill health or perhaps permanently because one of the spouses passes away. And then, of course, all the work that you've done has been, and even if you leave for a year due to, you return to the UK for a year on a temporary basis due to ill health, that triggers again domicile. So theoretically, you can avoid UK inheritance tax after 5 years of non-UK tax residency, but in practice, it's much more complicated than that. We go back to the ties, business interests, social connections, family interest, property ownership, and then something which no one mentions, intentions. This is the big one, the all-encompassing clause, the one that HMRC latches on to when they want to get some of your hard-earned money. And that could, intentions alone could catch you and determine that you are deemed domicile for IHT purposes. So the message here is that insignificant ties can always be challenged. HMRC have been known to rely on the most tenuous of grounds to dismiss claims that an individual has chosen a domicile of choice. Not just chosen, but acquired a domicile of choice. And the most high-profile case is the Welsh actor Richard Burton. He lived many years in the United States before moving to Switzerland in 1957. He then spent 27 years in Switzerland before he passed away in 1984. The UK tax authorities made an inheritance tax claim on his estate on the grounds that he never actually relinquished his UK domicile, which is quite interesting because he had severed his UK ties 30 years earlier, and he had had PACA advice, professional advice, following best practice. But unfortunately, HMRC successfully claimed that since he had bought, which is quite an interesting thing, a burial plot in Wales, he had emotional ties with the UK, and he always intended to return to the UK at some point. So he never had a domicile of choice. He was stuck with his domicile of origin. And apparently, the grounds on which they successfully claimed tax on his estate were that because he requested to be buried in a red suit with the colour of Wales, with a copy of Dylan Thomas' poems, it was evident that he had never really left the UK, that those emotional ties, those intentions to return were always there. So the end result of that folly was that his worldwide estate was subject to, which was 5 million at the time, was subject to tax of 2.4 million. But the good thing is that once you are non-UK tax resident, an expat really has a lot of tax planning opportunities to restructure their assets and their financial affairs to mitigate and perhaps even eradicate that inheritance tax liability. Of course, that depends on the personal circumstances, but early tax planning is key. Like everything else, if you leave it to when you're on your deathbed, it's too late. You just have to plan from day one. You exit the UK, you move to another country, you start planning from the very beginning. Okay. That's the advice we always give.
So the key message is really plan on the basis that you are quite likely still be exposed to UK inheritance tax, either now or if you plan to return. And the good news is that as an expat, there are those planning opportunities.
Yeah, you plan for the worst and hope for the best.
Okay, wonderful. Okay, great, Paul. That's really helpful. And I think what we'll do is a little bit later in the presentation, we will talk about there are a few opportunities for people to plan against UK IHT. So we'll move on to part two. I will talk very briefly about visas, not really our intention today because the webinar is about the NHR, but now we live in a post-Brexit world and of course, it's not only Brits that need visas, but those who don't have an EU passport. So if you have an EU passport, great, you can gain residency in Portugal. For those who don't, as we stated earlier, you need to gain residency before you access the NHR scheme. So there are two main visa types. There's the golden visa. Now the golden visa doesn't actually require full residency. You only need to spend a minimum of 7 days in Portugal in the first year and 14 days in the next 2 years. Now, again, I know I keep repeating it, but if you have the golden visa and you spend 20 days in a year in Portugal, great, you can retain residency there, but the NHR won't work. The golden visa does require investment in Portugal. Traditionally, this has been where real estate, a minimum generally of €500,000. But again, the landscape is that has changed and they've restricted the areas where people can buy qualifying property in. So not in Lisbon, not in Porto, not in Algarve. Obviously a clear way to try and kind of drive people to those less popular areas. To gain the golden visa, there are other investment methods and we will be doing a webinar on another day to cover that. So, you know, please keep an eye out for that and register if that's something that interests you. The second main visa is the D7 visa, sometimes known as a passive income visa. Relatively straightforward. You need to demonstrate that you have passive income of just over €7,500 per year to support your lifestyle in Portugal. The aim is the individual demonstrates that they won't be a burden on the state and that they can self-fund their lifestyle. It's a process that you need to go through. You need to apply originally in the UK and then register with CEF in Portugal. Again, you know, we will have information covering this in more detail on other webinars. There's also the D27 visa aimed at entrepreneurs establishing a business in Portugal, and there's also the employment visa, which has to be granted or applied for by an employer in Portugal to do that. So that's the residency, but we're here to talk about the NHR and more importantly, the tax benefits. So here we are, we have an individual, they've got residency, they've followed all the steps properly, they've gained their NHR within the right time frame, great. So what are the benefits they're going to have? So employment income, that is taxed at a flat rate of 20%, which is a very, very nice rate to pay on that. The key is that if you are in employment, your employment needs to be classed as a high value activity in Portugal. So they have a list of occupations that qualify for this. We won't go through the whole list today because we'll be here all afternoon. So, you know, please reach out if that's something that interests you or concerns you. Foreign sourced income is exempt from tax in Portugal under NHR, as long as that is deemed taxable in the country where it is generated. Now, I think at this point, what I should add is that the NHR is built on the basis of the double taxation agreements it has with various countries, the UK, of course, being one, but I think they have a double taxation agreement with around 96 countries, I think, Paul. So the details of the double taxation agreement then dictates how income can be taxed. Which takes me to dividends, and we refer back to the agreement between the UK and Portugal because that's a lot of our focus, but dividends can be a huge win via NHR. It's a little bit of a quirk of the double taxation agreement, but effectively Portugal deemed the dividends taxable where they've arose, i.e. the UK. UK deemed these taxable where you are resident, i.e. 'i.e. Portugal, and therefore under NHR the dividends, the tax rate is 20%. structured and managed properly can be withdrawn with 0% tax. So
so long as a double taxation treaty. I think that's key.
Exactly, yeah. It's dependent on the double taxation agreement. So we can, the UK Portugal side is very clear. If the dividends are coming from a different country, then that has to be assessed on an individual basis. Now, pension income, and a lot of people like to retire to Portugal for obvious lifestyle reasons. Well, there are financial reasons as well. Under NHR, it's a flat rate of 10%, but it is possible to reduce that down under NHR to as low as 1.5%, which is incredible. And we will cover how that is possible a little bit later. I think there were the two areas that aren't covered by the NHR. One is capital gains tax, which has really been overlooked, I would say, Paul. And it's a flat rate of 28% in Portugal, inside or outside NHR, and that one's really been kind of missed out. Whether that was intentional or not, we don't know. And the other is NHR doesn't affect succession tax, inheritance tax in the UK. Now, succession tax in Portugal shouldn't be a concern for most people. If your estate is passed on to direct family members, so children, grandchildren, siblings, then there is no tax to pay. So as Paul went through earlier, it's just that kind of UK inheritance tax that you need to be kind of concerned of.
Can I just say something, Matt?
Absolutely, yeah.
You've covered some very interesting subject concerning the visa types and the tax benefits in HR. I go back to the same point. Based on historical experience of dealing with many inquiries over many years.
Yeah.
I think sometimes experts coming into Portugal and indeed other countries can be penny wise, pound foolish, because they think they can find an easy way of doing it, a cheap way, Googling typically, or find, or from a friend or from the pub, and they try to follow it through, and it saves them money at the front end, but has disastrous tax consequences further down the line. Yeah. So that is always an area of concern, and we tend to get cases after the done all the damage. Yeah. Can you help us? Yeah. If they had followed a route, a safe route, you wouldn't go and Google for if you had a condition, Google and then prescribe some medication, right? You go to a professional. Absolutely. And this is something I've never quite understood, because dealing with finances, the tax liabilities are so considerable, and the scope for making mistakes, or the ability to make a mistake, is very easy unless you know the terrain. No. So that's why I use the expression penny wise but pound foolish, because you think you're being very smart, but in fact you're making a big, massive mistake. No, absolutely. And once you make that mistake, it's difficult to undo that. Completely. You can move on from there, but the damage is done. Absolutely. I guess it's a way to say that. Thanks for that, Paul. So we move on to tax mitigation and succession planning. So, and we mentioned pension income a little bit before, and the 10% on pension is on your UK or pensions you hold elsewhere. But and I teased everyone, there was 1.5% tax rate, and that is potentially achievable by the use of QROPs. So if you don't know what a QROPS is, it's a qualifying recognised overseas pension scheme. For those resident in Portugal, it's sensible to use one that is based in Malta. Again, that's because of the double taxation agreement that those two countries have. So there are quite a few reasons for the use of a QROP. So the QROPS is funded by a transfer of your UK pension. So number one, if you are close to the UK lifetime allowance, which is
currently just over £1 million. At some point, when you want to access that income, you will have what they call a benefit crystallization event. And if your pension has exceeded that amount, then you will pay a large tax payment of up to 55% if it's a lump sum on that excess. Now, if you were to transfer your UK pension to a QOPS before exceeding that limit, then the benefit crystallization event happens at that point, and therefore any further growth of your pension invested wisely continues to grow. It goes over that lifetime allowance limit, not a problem. No tax charge at all, because you've transferred it before you reach that limit. So for those who have a pension approaching that size, it's a very sensible idea. Now, I will come to the income shortly, but we compare to the UK pension. So you have a UK pension, you die age 75 or above, then your beneficiaries who inherit your pension, they will have to pay tax at their marginal tax rates to receive that pension. If it's a QOPS, it doesn't matter. Die before 75, over 75, there's no tax liabilities to your beneficiaries on that pension. Because it's a pension, it's outside UK IHT. As long as your beneficiaries are direct family members, no succession tax. So again, you know, we're all living longer. It's a very nice way to pass on your pension to your beneficiaries without them being concerned about further taxation. And then the income that I mentioned. So yeah, pension income is 10% in under NHR. That's great, but by the use of a QOPS. Now the income can be structured as long as it's structured properly. The way the Portuguese tax assesses the income in this way is they can't differentiate between what is the original capital and what's the growth. So to get around that, they deem 15% of the QOPS to be growth and therefore taxable. So 15% of the element of the income is taxed. That will be taxed at 10% income. There you go. You get a 1%, so 1.5% effective tax rate on those income payments. Now that is as long as you take, you know, a regular income from that QOPS. It doesn't work if you want to transfer your pension and say, right, I'm going to take it all as a lump sum, or I'm going to take large payments. But as a regular income, you can pay tax just at 1.5% on that. And then, so we're talking about kind of tax mitigation, and you know, we like to link this back to what Paul spoke about earlier about UK inheritance tax. So, okay, you've told us we need to plan about this. What can we do? And there's a few methods that you can use in expats, but a QNUPS is a very, very useful tool. So a QNUPS is a qualifying non-UK pension scheme. I've heard it being referred as the sister product of the QOPS, but the difference between the two is a QNUPS is funded from a lump sum investment. So you have maybe proceeds from your business, house sale, shares in the UK. You can invest this in a QNUPS. So like a QOPS, there's no capital gains. The income can be structured in exactly the same way, 1.5% tax on that. And a key to this is, I guess we have to add the caveat that a QNUPS has to be set up as a genuine retirement scheme, but the contributions you make into the QNUPS are immediately outside of your estate for UK IHT. And that applies even if you return to the UK. So you're effectively self-funding this overseas pension scheme, and you are designing that for your retirement. So I can repeat, it has to be a genuine retirement vehicle, and the way they measure that is the funding has to be in line with your wealth, age, and future income requirements. So I come back to something Paul said earlier and said, right, you need to plan early, because you get to 75 are even older and you realize, okay, I've got exposure to a large IHT bill, and I've got the QNUPs that these guys told me about. Well, at that point, it's not going to be a genuine retirement scheme. You've left it too late to do that. So really important to assess your options and plan early, because it can be a really, really kind of powerful tool for your tax plan.
I think pension trustees will not touch you once you get anywhere close to 75. 75 is really pushing it, but they will accept a QNAPs.
Yeah.
But anyway, once you hit 75, that's it.
Yeah.
The doors are permanently closed.
Yeah, I'd say that. And as you approach 75, effectively the amount that you can fund into that will reduce. Is really as simple as that, because you are growing older in age.
Yeah, I've got a few questions to ask you, but before I do that, I have to go a bit back to the question of NHR, because one of the weaknesses of NHR, you want to?
Yeah, let me, if you don't mind to know. So the final use, and this is a relatively new product available to expats, is a Portuguese compliant bond. So in the UK, where we used to things like ISAs, offshore bonds that would give us 5% tax-free withdrawals, once we leave the UK, then the tax benefits of those are no longer available. So you have an ISA, it's great as you're in the UK, but it doesn't shelter you from the capital gains in Portugal that, as we know, is 28%. So we have the Portuguese compliant bond. So this is a single premium. So it's a one-off investment into a life insurance wrapper around a portfolio of assets. So the great news is there's no immediate capital gains, and you only pay tax when you access that income. And the way the Portuguese compliant bond is very important that any investment is in one that is fully compliant, that is signed up by taxation in Portugal. And the way it works is it's most suitable for those who don't have any immediate need for this cash, because the longer you are invested, the lower the tax rate is on the withdrawal. So day one, it's 28% on the gains. So you're taxed on the gain element of the withdrawal. So day one, it would be 28%, and this reduces down over time until you get to year 8. And we've got a little bit of a photo there that shows that. So it goes down to, so effectively, because we've used an example of an investment that started at 100,000 euros, made a growth of 50% over 8 years. So when it comes to making the withdrawal, they separate what has been the return of capital and what is a gain. So in this example, a third of that is a gain. It's after 8 years, 11.2% tax is applied. So when we take that all into consideration, you've got an effective tax rate of 3.73%. So it's a good tax planning tool for that. And when we talk about capital gains being a weakness of the NHR, it may sound weird, we're just referring to investments and shares, but the other issue in Portugal is property. So again, in the UK, we're used to, you've got your main property, you sell that, it's your main property, there's no gains. In Portugal, if you sell your property, then 50% of that gains is subject to capital gains tax. Now, there are caveats with that. So if you're selling your property and you reinvest that into a property of equal or greater value, then there's no capital gains tax on that. But the issue comes with somebody's going to sell their property and don't want to reinvest in property, or if they're downsizing their property. If you're downsizing your property, which many do as we get older, then the difference between that could be subject to capital gains. So A way around that is if you invest in an approved scheme, and the Portuguese compliant bond and the QNOPs both apply to this. If you reinvest those proceeds into one of those, then again, there's no capital gains tax. So for those who are downsizing their property, they've got a nice gain on their property, there's taxable, they don't want to reinvest that in property. The Portuguese compliant bond or the QNOPs are both very sensible ways of doing that, and you make a tax saving immediately because you're not paying that 28% tax on the gain.
So effectively, there's two routes. You sell your property and you downsize into a smaller property.
Yeah.
And you avoid the CGT, correct?
No, so if you downsize,
okay,
there is the difference between what you're selling and what you're buying, that can be exposed to capital gains.
Okay. So, but if you use a combination of both, you
Absolutely.
downsize and then invest
Exactly.
the difference, you have no liability whatsoever.
Exactly. Good. So okay, we'll move on to part 3. And well, we're going to talk about UK pension transfers and the taxation of pension income. But we've already really covered the taxation of pension income. You have the 10% or the 1.5% if you decide to use a QOPS or a QNOPS. But one thing we wanted to highlight was the treatment of UK pension transfers. Because we speak to a lot of people, they're interested in taking advantage of the QOPS. And it's something that's been very useful before, but the landscape is changing a little bit. So some years ago, I think it was 2017, was it, Paul? The UK introduced the overseas tax charge. So the way this worked is if you were moving your pension overseas, there was an immediate 25% charge on that pension transfer. Now, that didn't apply if the receiving pension and the individual lived in the same country. So for example, you moved to Australia, you transfer to an Australian pension, not a problem. And the other side of that rule was it would work if the member of the pension scheme and the pension were both resident in the EU. So the example we use today is the pension scheme is in Malta and the individual lives in Portugal. Now, again, we're in a post-Brexit world now, and although that hasn't changed as yet, it is possible that will change. So again, it's important that people look at these options, and if it's something you're interested in, we would recommend looking at it sooner rather than later, because history tells us that these rules may change, and the UK pension industry is making a lot of changes enforced by the regulators, and they have now recently introduced what they call the traffic light system, and this is where somebody looking to transfer their pension either within the UK or offshore, they have to go through this traffic light system, and it may bring up kind of warnings, and it effectively gives the existing pension scheme an excuse to investigate that transfer in further detail or put a halt to it. And they are, in my view, Paul, and what we're seeing now is these pension transfers are taking longer, and as an excuse not to lose the assets, that the pension schemes are using this traffic light system to try and stop these transfers going through. Now, there's trying to clean up this system, but again, we can see the direction it's going, and the UK pension industry not wanting to lose these assets overseas. So the window to take advantage of the QOPS is closing. So we would recommend, again, and it's a theme of this webinar, that you plan in advance and take advantage of these options while they're available. So we talked about capital gains tax, and there's a few options there, but what about, Paul, and if you can help me to answer this, What about somebody who's got maybe a large capital gains tax that they're already exposed to, that they may kind of liquidate? Maybe they've got a UK business disposal or a similar in the UK. Is there any options?
I think, unfortunately, non-habitual residency, whilst it's a fantastic and wonderful scheme, I think if there's one weakness in the tax benefits is that they treat capital gains is subject to the same rate of tax, whether you qualify under non-habitual residency rules or under normal Portuguese tax residency. They make no distinction whatsoever, which is quite unusual, because when they structure schemes of this nature in other jurisdictions, they try and make it more attractive, right?
Yeah.
But not in this case. Whether you are normal tax residency in Portugal, whether you are tax resident in Portugal under normal rules, on the non-habitual residency, you pay a flat rate of tax of 28. Now, how can you potentially overcome that? There's one way of doing it. Non-habitual residency allows you to postpone your non-habitual residency for a year or two or whatever.
Yeah.
I think you do forfeit the years that you give up.
Correct, yeah.
But at least it allows you to extract yourself from non-habitual residency. So let's, for argument's sake, that on the 1st of January 2023, in fact, I have a case now of someone living in the Algarve that is looking at that possibility, because they have a massive capital gains tax liability. So one clever way of doing that is and it could be the disposal of a business in the UK, but equally it could be investments which are not structured inside the QROPs, the QNAPs, or a Portuguese bond, right?
Yeah.
Where you defer capital gains tax liability or avoid it completely. One way of doing it is you postpone your non-habitual residency on the 1st of January, on the 31st of December 2022. Okay. You leave Portugal, you establish your tax residency in a third country where there's no capital gains tax. Okay. And for argument's sake, let's say that's Gibraltar, firstly, because it's it's 3 hours away from Portugal. And secondly, it's our home jurisdiction and we can comfortably cover this point. You establish your tax residency in Portugal for a year, in Gibraltar for a year or 18 months or whatever. I think we have to be mindful of the fact that the tax years don't run concurrently. Yeah. Portugal runs it on a calendar year basis, Gibraltar runs it from 1st of July to 30th of June. So effectively what you do, exit the UK and Portugal on the 31st of December 2022, establish your tax residency in Gibraltar on the 1st of January 2023, for argument's sake, stay for 18 months, maybe until the 30th of June 24. During those 18 months, dispose of your UK property. So sell your UK business, yeah. Dispose of your UK business interest, no capital gains tax, especially if you used, what do they call it, BADR? There used to be entrepreneurial relief, up to 10 million is down to 1 now. Yeah. So dispose and sell your UK business, do it during that 18-month window for 0 capital gains, whilst tax resident locally here in Gibraltar, and then return to Portugal, on the 1st of July 2024. Right, yeah. And meet the 6 months, and that's it. And from a UK perspective, it's irrelevant. So you can do it for UK business interest, but you can do it if you have investments which are not held in the right structure. And you can do likewise, dispose of them, avoid the capital gains tax, and then return to the NHR. Yeah. And you effectively, even though it's 18 months, for tax purposes, it's probably only 1 year, yeah? Okay, yeah. Because in 2024, you can try and jump in again.
And I guess with the UK...
Or at worst, it's 2 years.
Yeah, the UK, I think the rules are you have to be out of the UK for 5 clear tax years. So you've done a couple of years in Portugal, a year and a bit in Gibraltar.
It's irrelevant to the UK.
It's accumulation, yeah. Okay,
Correct.
perfect, wonderful. So we've got a few frequently asked questions which we may have covered already,
Okay.
but Paul, if you've got
I've got three, Matthew, you
Okay.
give me the time. First one is, can I move, can I obtain non-habitual residency in Portugal and move there, but live in the UK or elsewhere permanently?
Okay. Well, this is one I guess we covered early, but there's a reason why it's a frequently asked question, because it happens so much. And I think it's worth reiterating. If you're not living in Portugal, you're living elsewhere, I mean, hypothetically, you could have NHR, but it's pointless because you are being taxed elsewhere. But the general rule is you need to be living in Portugal 183 days or more. It needs to be your main country of residence.
My second question is I think requires quite a more explanation, yeah? Might be a more lengthy response. But very often we get asked, what happens after those fantastic 10 years of non-habitual residency? How am I taxed post non-habitual residency in year 11 effectively?
Okay. Well, yeah, so again, because NHR is just a tax scheme, it doesn't affect your residency. There's no impact from your lifestyle. It's not they're saying, okay, year 10, get out, we don't want you in the country. You continue to stay there as long as you've gained your residency, which after 10 years, you can have permanent residency by then. But the tax scheme itself ends after 10 years, and that's where you lose the benefit. So the 10% on pension income, the 20% on employment income, those now revert to normal Portuguese tax. So normal Portuguese tax is similar to the UK and many other countries in the sense that it works on a tiered rate. The more that you earn, the higher the tax rate. So again, I think this is another case where it's very important to plan in advance, because you know those higher tax rates are coming. So if you can kind of structure your assets well in advance, then you can take advantage of the QNOPs, the QROPs, the Portuguese bond. You can make sure that you extract, from your business via dividends during that 10-year period, because again, you will lose, dividends will be taxed, I believe at 28% post NHR. So yes, you will just go on what is, I guess, the normal taxation system, and therefore it's important to take advantage of the 10-year of the NHR, but ensure that as part of your planning, you take into account that in year 11, the taxation will change.
But am I not right in saying that in year 11, so long as you have it in QROPs or QNAPs, your tax liability on any pension income is still, is not even 10%, it's single digits. So you might be paying 1.5 or 10 during NHR. But post NHR, if it's in the right scheme, you're still in single digits, between, what is it, 4 and 7? I don't know.
No, it's absolutely the same, because the 15% of the income is only the 15% that's taxed. So it depends on your marginal tax rates. So it starts as I think it's the low end around 2.75 up to around 7.25. So it's single digits. So yeah, even outside of NHR, to pay that level of tax on your pension income is
you're quids in,
absolutely.
So for QROPs, for QNAPs, and I guess for this, the Portuguese bond is completely unaffected, no?
Exactly, there's no change. But again, the Portuguese bond, because we talk about this tax rate reducing, that's regardless of NHR, because we talked about the capital gains not affecting it. So if you can, the earlier you can make that investment, you get further down the line and you're paying less tax, which, we're all happy to pay tax, but if we plan in advance and there's legitimate ways to pay less, why not take advantage of that?
Absolutely, makes sense. I've got one final question, Matt.
Okay.
Is it possible that the NHR scheme can be changed or withdrawn completely? Because we saw a change, I can't remember, 2017, 2019?
Yeah, around 2019. So for those who don't know, actually pension income was at 0% prior to that. And I think it was a bit of pressure from other European countries where they basically said, look, this is,
Tax haven, yeah.
Yeah, I guess effectively it was being classed as a tax haven. So they increased it to 10%. So we know from what's happened in the past that there can be changes made to NHR, but what was interesting with those changes is that those already in the scheme still benefited from the 0%. So if you obtain NHR this year and the taxation remains like this, we can be fairly confident that you will benefit for the full 10 years. We can't guarantee that, and will the scheme be withdrawn? Very unlikely.
But retrospectively, I would say probably no.
No.
So, sorry, Matt, one thing, I've seen two people raise their hands, but can we maybe get back at the very end?
Yeah, of course, yeah.
Because I can see there's a lot of questions there, including on the current subject.
Yeah, no, I think the chat was disabled, but it looks like it's available now. So we've got a nice lineup of questions at the end.
Okay, we'll do it at the end, yeah?
But not yet, Paul, because you quizzed me. So I need to ask you a question.
Okay. Yeah,
I think that's only fair.
No.
A much more important question then. What is one piece of advice you would give to anyone who is planning on moving to Portugal under the NHR scheme?
Okay, very good question. I think it's always a very bumpy road for the reasons that we've covered in this webinar. So I think you need a trusted advisor by your side that can make the journey easier for you, ensuring a smooth and seamless transition to your new country of residence. I think that is, without saying, is key. So like everything else in life, and particularly when it's around the issue of taxation and finance, failing to plan is really planning to fail. And you need a timeline, you need a strategy, and you need an advisor holding your hand along the way to make sure you execute it correctly. If you miss some of the key steps, which can happen, and if you're not properly advised, then it can be really costly. I would always advise that you plan first and you move later. And planning begins certainly well before you exit, which is why we go to the UK and we meet our clients there and we hold their hands through the journey and we make sure we've taken the steps in the right order.
Yeah.
And I always, when asked that same question, I always say the same. There's no, it's okay to be the tortoise. You don't need to be the hare. This is not a race to the finishing line. This is all about executing things correctly. And I would go back to the issue of UK inheritance tax, which is where I started at the beginning. So we go full circle. I think when it comes to UK inheritance tax, it's always advisable to plan for the worst, assume you're tax liable in the UK, and then hope for the best, so that a negative posthumous determination by HMRC, like in the case of Richard Burton, that determination does not reduce the inheritance of your children. So you have to be forward thinking in that regard and plan it. So important that you plan it from the very, very beginning. Don't leave it until the very end, which more often than not happens. Yeah, people go, I've still got time, but no one knows when the time comes, right?
No.
So you have to think about that very, very carefully.
Nice. It's surprising so many people don't take those steps to plan, and it's such a huge event in someone's life, but I know it's exciting moving to a new country and such a beautiful country as Portugal, but so planning is key. Okay, wonderful. So finally, and tying into that, Paul, nicely, we had the roadmap, and maybe not the most glamorous map you'll ever see, but it's really a nice kind of summary of the sequential steps that you really should be taking before you commit to anything. So it's important to gather all your information and then review this. Once you've done that, then you can discuss what are your problems, fears, pain points, and your concerns, which allow you to understand all your needs and requirements. And then it's important to identify your current and future sources of income and taxation requirements, and then establish the amount of time you want to spend in various countries. We go back to the UK statutory test. And then you've got to evaluate the viability. If you want to spend 200 days in the UK, then it's not going to happen. It's not for you. Once you've done that, then you can consider your UK exit strategy, review the UK statutory test, and review your UK domicile and any potential liability to UK inheritance tax, and identify those UK IHT mitigation techniques that we've discussed today. You consider the residency and then the visa options for those people who need it, and review these and the requirements to obtain that. And then you are in a position to understand the tax planning opportunity ahead and to clarify the process. Once you've done that, you find your dream property, either rental or outright purchase, secure your mortgage finance if required. You address healthcare requirements, which may be a requirement of your visa application if you need one, and then you're in a position to apply to the visa. So you see there's so many steps even before we get to that stage, and here then you can consider that impact of the change of residency on your assets and your liabilities, and make sure you plan properly to optimize your tax position. And then conduct a thorough review of your pensions, saving, investment, and something we haven't discussed today, actually, your protection policies as well, because it's quite likely that these may not provide continuity of cover in your tax residency or your new country of residence. So a lot of planning, a lot of important steps, a lot of benefits you can get at the end of that. So it's worth doing all that. So wonderful. Thank you for listening to us. We come to your questions, which there seems to be a few. So Jane, we had you from the beginning with the trouble with sound, which I believe we've resolved, and looks like Colin had a problem with the chat, but seems to have got his question through. So, so Colin's got a question there. If I have NHR and a property in the UK, I sell the UK property in the 9th year of NHR, I will pay capital gains on the profit since 2015, I think he's talking about in the UK then. How is that further taxed in Portugal? And he specified he bought the property in 1996. So it's a good question. So the answer is, Colin, is you pay the capital gains tax in the UK, as you say, on the profit since 2015, and there are two separate ways that can be calculated. So use the one that's most in your favour. But because of the double taxation agreement between the UK and Portugal, there will be no further capital gains tax on that if you are within the NHR. Outside of the NHR, there's possible further capital gains tax on that. So it's a very good question, actually, and I think if you are retaining UK property and plan to sell it when you become Portuguese tax resident, doing so within that 10-year period of 10-year period of NHR is very important. I think that's fair.
Yeah.
Okay, so we've got a question from Alex. Does the property rule also apply to buy-to-let properties? I'm not quite sure what you mean there by the property rule, Alex.
I think he's referring to the prior point that we've covered.
It may, if it's a case of does this when you talk about being UK domicile, having property in the UK, then I would say yes, that would retain your UK domicile because you've got UK property interest. If you're talking about disposable of capital gains, which Paul said about using the Gibraltar technique, that wouldn't really work because they're physical properties in the UK, therefore you'd pay the capital gains on those in the UK. So I think it's probably one of those points, maybe.
It could be. It's not very clear, but I think you're quite right. I think you've covered it from two angles. And Alex, if for whatever reason that's not the intended question, please clarify, and we would be happy to answer.
Okay, so Imran there telling us that he will go to Portugal someday, so I'm sure he's looking forward to that. Okay, so a question from Jane, is the 10% tax or less on pensions another quirk of the DTA, so there is no further tax due in the UK? So I think that's a good question, actually. So the majority of pensions will be taxed based on where you're tax resident. There's a very small amount which are kind of civil service. I think maybe the NHS pensions, which would be still taxed in the UK. But the majority of pensions are taxed your country of residence. Now, the problem is UK pensions tend to pay you net of tax. You can look to claim that back from the HMRC. There are certain ways it can be structured to enable your UK pension provider to pay it gross, but it can be a little bit complicated. If it's a multi-CUROPS, they pay these gross anyway, so 100% there'll be no tax in the UK on those.
Yeah, that's why it's always advisable if you move to a third country to transfer your UK pensions to a structure which is tax efficient in your new country of residence.
Exactly.
Rather than, I'll keep my UK pensions,
yeah,
but I'm actually resident somewhere else. You can do that, but it's not the best advice.
Exactly. So here we have Colin. If I have an NHR and a property in the UK, presume I sell the UK. We've covered that one. So he's very keen on that question.
Yeah. Harry?
Okay. How long should one allow from start to finish for NHR, and what is the approximate cost?
I think that's one to take. If we can reach out to Harry after the webinar, we can touch upon that.
Okay.
Because there's no hard and fast rules, you know. It depends on so many different issues.
Yeah, no, absolutely.
Not so much on the cost, but more on the the time it takes. Yeah?
I think so, because we're not sure about your visa situation and
family situation. You know, you might have a partner that has a European passport, and then you can qualify on the back of that.
Yeah.
It depends on when you plan to move. You know, what time of the year. There's a lot of issues to consider.
And also, if we're given a catch-all answer to that question, I think we're doing what we're complaining about other people, aren't we? I think it's important, you know, but I don't think it is very important to know exactly the right thing to do for your situation, because if we follow what someone else has done, it might work for them and then we fall foul. So Alex is saying regarding the domicile, so he's buy-to-let properties. So correct me if I'm wrong, Paul, but if someone's got buy-to-let properties in the UK, I would say they would definitely retain their UK domicile because they have a link in the interest to the UK.
It's a difficult one. It's another link. If you want to sever your ties with the UK, you know, it's always advisable to, you know, ties to a season ticket holder, you know, golf club memberships, property, whether it's main residence, definitely the main residence you should sell, or buy to let. Any ties with the UK really should look at severing. Yeah. Because even as I mentioned earlier, the most 10 years of ties is enough to catch you. Yeah. Yeah. So I would agree with your summary.
I think for me as well, the rules are so grey, aren't they? Probably intentionally so. So it's best to treat that with caution. So you got a message from Paul there. We met Paul last week in Portugal. Yeah. So hi Paul, good to hear from you again. I'm sure we speak shortly. Jane has asked about a civil service pension transferred to a multi-CUROPS. Jane, I think again it's probably a conversation that we would be better to have on a one-to-one basis. Yeah. To see what the options are available for you. So please feel free to kind of reach out to us. Yeah,
and the last one, Matt, we're happy to answer questions, but you know, we have as a core value, you know, ethics and transparency, and we don't deal with anonymous attendees. I don't think that's in keeping with our values. Yeah. So I'm happy to answer any question. Everyone is registered properly but I'm not happy to answer a question from an anonymous individual.
Yeah, yeah. So if you registered anonymously by accident, then you're more than welcome to reach out to us, and you know, we're happy to answer any genuine questions. That's not a problem at all. Which is there's another question from whoever that individual is. So yeah, please feel free to reach out in name and introduce yourself, and we're happy to have a conversation.
Absolutely.
Yeah, wonderful. Okay, great. So I think that's all the questions for now. So
there's one.
oh, sorry, there's one that's come for a breaking news. Okay, so if I live more than 183 days in ward, is this the only rule that applies to determine my country of jurisdiction? So I think if you live more than 183 days in Portugal, then that deems it, but we refer back to the UK statutory test.
Exactly. If you spend 184 days in Portugal, but then based on the UK statutory residency test under UK ties, you spend more days than you're legally entitled to stay, meaning based on those rules, then you trigger UK residency again.
Yeah. So
you can't look at Portugal in isolation.
Yeah.
Because look, you could be traveling around and triggering residency in 3 locations.
Yeah.
As it can happen quite easily. In answer to that question, without understanding the travel arrangements of that individual and where they intend to spend the time, how do they intend to spend the year, in different locations, and how much time? If they give that information, maybe we'll be in a better position to assess whether they are triggering residency in the UK or any other third country besides Portugal. It's not just, I've done my 184 days, that's it, I'm safe. Doesn't work.
And I think it goes back to what we said at the start, that there's not an answer that covers all scenarios. Absolutely. If only it was that simple, and that's where people need to do their homework. They need to take professional advice to make sure that they know exactly that they're doing the right thing.
So let's answer Milan's, because I think it's Milan who asked the question anonymously. If I leave my UK SIP in the UK and then move to Portugal, how will it be taxed once I begin withdrawals? Will it be taxed at 10%?
10% in Portugal.
Rather than 1.5,
Yeah, and I think it goes back to the SIP is in the UK, you start taking withdrawals. The UK is likely to take withholding tax on that, which again, you know, you can claim back from HMRC, but anyone who's dealt with HMRC knows that could be a painful process. I think there's probably one thing we need to add as well, that if you start taking income withdrawals, we're not talking about the tax-free lump sum, but start taking income withdrawals from your UK pension, then as soon as you start that, then you can't transfer to a QOPS.
You're closing the doors completely.
Yeah, exactly.
So before you even consider starting drawdown on your UK pension, you need to think tactically, and you need to be forward thinking and consider, am I planning to leave the UK, in which case I really shouldn't touch the pension. Exactly.
Wonderful. Well, look, some really good questions there. We appreciate those, and those of you who've attended. Our contact details are on there, the invite that you would have attended. So for those who want to have a little bit more of a in-depth chat about their personal situation, and I'm sure we can help you out, feel free to reach out, and I'm sure we'll be speaking to some of you soon. Okay, thank you very much. Bye-bye. Bye.
Bye-bye.